All right, good morning, everybody, and welcome to the Bookmap Pro Trader webinar. Today we have Brent Kochuba, and we're going to be going through some futures and some stocks here. Brent has been he's done a bunch of webinars with us before in the past here. He has a history in institutional background here. Worked for BofA, Credit Suisse, and also with Wolverine, representing their electronic derivatives trading platform. So now Brent is working with Spotgamma.com. This is his invention here as he moves forward with publishes various metrics on options data. If you want to reach out to Brent, you got his website here, spotgamma.com. There's subscriptions for and different products here that he has. I'll be pasting these into the chat so you can access those if you want. I'll go through some disclosures and then we'll jump right in and get going here. General disclosure: all Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Risk disclosure: trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. All right, so with that said, we'll jump right in and welcome, Brent. Nice to have you back.
Thanks, Bruce. I appreciate it. It's been a couple months here. It's been a wild few months since.
Yeah, it has. Brent and I talked about this. We thought we'd just go through some of the levels in that he offers. This is his product over here with the cloud notes that is within Bookmap, broadcasted or within Bookmap here, displayed. And then there's also this hero indicator down here that is showing the hedge impact of real-time options with these triangles that you see on here. But some interesting stuff in here. And I just want to let you know about this hero indicator. What it's showing you here is about the options, as well as these levels here are also regarding options from when is it updated? 3 a.m. Is that right? East Coast time? Okay.
That's right. So every night around midnight, roughly Eastern time, the exchanges publish updated open interest. So we read that open interest, and that is what is the underlying for the trading levels that we publish every day.
Yeah. So I don't know, what do you think? What's going on out there, Brent? And going through some of these instruments.
Sure. So this morning, what we're looking at here are some big options levels at 4,300. And you can see that in white there. It's called L3. Now, L3 means it's the third largest level that we're reading in the morning of what the biggest options levels are. And the basic idea around any of those levels you see in cloud notes is that as the market approaches those levels, I think options hedging flow picks up. So options dealers and market makers may increase their hedging flow around those labeled levels. And that is what creates support and resistance at those strikes. Now, the second thing that you mentioned is the hero indicator at the bottom. So if you think of the labels in the cloud notes, the open interest as the positions that we come in at the start of the day, and we think those are key support and resistance. Hero indicator is reading all of the real-time options flow taking place, in this case in the S&P 500. So that's the SPX index options as well as the spider options. And it's showing you what the estimated hedging of that flow is. So as traders buy calls or sell calls, buy and sell puts, we believe that market makers on the other side may have to hedge that order flow. So just contextually to talk about what's happening in the first 30 minutes of trading so far, you can see that the market had rallied pretty sharply. It rejected right around that vol trigger area, which is a major resistance line for us. The market, on open, receded from that level, but what you can see is that the options flow is somewhat bullish to start the day. And I say bullish because that green line, the hero indicator at the very bottom, is trending up. And that is telling us that traders are selling puts and or buying calls. And that's what's called positive delta flow. So if you're a market maker and you're on the other side of that positive delta flow, that means as traders are buying calls or selling puts, you are doing the opposite, right? You're selling or buying puts, and that leaves you in what's a negative delta position, you need to buy some stock or some futures edge. So in general, if I was just look at the screen here on open, we dropped just below kind of one of our key levels, but the options flow is bullish, which tells me that we may meet back up that vol.
Yeah, interesting. So, looking at that, like we're down below a key level. We have quite a bit here on the bid, as you can see here. Buyers lining up here at 42.75 area, and plus you can see that the cumulative volume delta for the options overall is positive here.
Right. And so, I think contextually, if you think about what happened over this past weekend, people are worried about geopolitical risk, whatever may happen, Russia-Ukraine situation. And so you probably want to own some put protection, concerned about, some type of event beyond which we've already seen, right? So you want to own some options, own some put protection over the weekend. And then as the market opens and it doesn't seem like anything materially happened, at least enough to drive equities lower, you probably sell some of those puts because they're bleeding, right? If you want to put over the weekend, you basically just paid a big tax in terms of time decay and or what we would call a volatility reduction, basically implied volatility. So your puts are hurting and you want to just close those out quickly on the open. And I think oftentimes that's why you can see in this case you got some positive delta readings creeping in here to start the day. Now, if that hero signal was to turn down, say right around now, that would tell us that traders are probably buying puts. And that's obviously a bearish sort of signal or indicator. And so we would look to see, does the hero flow change if we test that 300 level? Does that tell us that, look, maybe dealers are hedging or traders kind of have now switched from a unwinding protection to wanting to buy protection, meaning put protection?
Oh, are you still there, Brent? I think.
Oh yeah. Hello?
Okay. Yeah. It's been kind of cutting in and out a little bit.
Is that right?
But yeah, I mean, so yeah, once you start to see this hero starting to turn around, maybe, then kind of look out.
Yeah, that's right. And in our one of the things we do at Spotgamma, for those who are new to what we do, is we write a daily note. So every morning around 7 o'clock Eastern time, we send out a note with our analysis of the options, sort of our framework and the way that we're looking at the market based on how options are positioned. And one of our core themes here has been that the equities has not seemed to react as violently to selling in some other shifts as some other asset classes. I think there's a lot of people who are scratching their head and wondering why equities aren't really dropping farther here. In fact, if you look at since February 24th, that's the official day that Russia invaded Ukraine, the S&P, as of roughly this morning, up around 2.5% to 3%, right, from the day they invaded. And I think that a lot of people feel like it is a major market negative, and you can obviously outline some of the tail risks here. And from a humanitarian perspective, it's sad, right? But just kind of callously talking about the markets, the S&P is actually up. And so why is that? Well, if you remember back to the December-January timeframe, people started to get concerned about monetary policy and what the Fed was going to do, and they started to add put protection way back then. And that put protection was going to cover them for the FOMC meeting that basically takes place next week. So next week, we flag that as a major event because you have the FOMC 16th, and then you have a very large options expiration on the 18th, which is next Friday. And so because the market went into this geopolitical window here over the last 2 weeks, well hedged, we think that the impact of the selling or the market was able to better absorb basically selling or any geopolitical concerns because it was already pretty well hedged because of the FOMC. Now, if you look historically at major interim bottoms in the S&P 500, they come right after big options expirations. So if you were to look back, for example, in December of 2018, there was the famous sell-off that coincided with Mnuchin calling the banks on Christmas Eve. Well, Christmas Eve was the day after a very large quarterly options expiration, and the market ripped higher after that. The same thing in March of 2020. The low was the day after March options expiration, and so we had another huge expiration in just this past January, right? And there was a significant low in the market the Friday after that January options expiration. So this type of expiration is coming again next Friday, and we think that that could be a catalyst combined with the FMC. That could be a good catalyst for a pretty good relief rally of. Now, we only look about 30 days out, so who's to say what happens in the next quarter or towards the end of the year? But we do think that when large put positions expire, it can bring a relief rally to the market. And so that's roughly how we're looking at things now over the next, so call it, week or two.
Interesting. I mean, so the the puts and the effect of them is actually having kind of a inverse effect.
Yeah. That's right. So if you look at these big levels here on your screen, we're in what's called a negative gamma situation, and many of you may be familiar with this idea. But basically, if we were to have lots of call open interest around the at the money strikes or where the market is trading, we would expect volatility to be much lighter or much lower, and that is because as the market trades and dealers have long call positions on, the way that they hedge basically suppresses market volatility, makes volatility lower. And in this situation, we have very large put positions on in the market, particularly in those strikes are really concentrated around right here where the market is trading. And so dealers who are short puts have to hedge with the market in that case. So as the market goes down, dealers need to sell stock to hedge. And if the market rallies, then they need to buy stock to hedge, to re-hedge, right? So what's happening now is we are in a negative gamma situation, and we'll get headlines that just fly in, right? Issues with whatever the geopolitical headlines be. Headline algos, I think, could read or traders can react rapidly to those headline readings. And then the negative gamma of the market, of the dealers, has to also react just as a sort of byproduct or a derivative of that, right? So imagine right now that it comes out that, some unfortunate bombing just took place and the market starts to sell. Well, that selling is going to be exacerbated or expanded because market makers have to start selling futures to stay hedged. And that's why you'll see, our levels will spread out a little bit. So if you see there's a level up there at 4,300, but the next one's not all the way down to about 4,240 in futures. And so you get these very large swings just as a function of the way that that options are positioned and the way that dealers are positioned. So if you sort of fast forward one more week to options expiration, well, a large amount of the puts, roughly about 35 to 40% of all total puts, expire next Friday. And so that's why we have it highlighted as when all these puts expire, well, that could reduce a lot of this hedging flow, right? A lot of the hedging requirements that are volatility sort of high.
So, I mean, what do you are kind of speculating, like might be a high probability scenario after options expiration?
So to me, if you were just to look historically at what happens around these large expirations, is that Monday after expiration is typically when the low is put into the market. And if you go to our site, spotgamma.com, we've written about this extensively. We talk about it in our daily notes. And the point here is that over the next 10 days, volatility is likely to remain very high, and no one is going to reduce their put positions really until FOMC, right? The monetary policy to me is the number one market and the number one thing traders are hedging. The geopolitical situation, is obviously a tail risk here. And if there is some type of a ceasefire, we could get a decent rally, right? Of course we could, but we think that rally be capped in the 4,400 to 4,500 area. So basically about 100 points up from here. Now, once the FOMC passes and people just understand what monetary policy is, have a better idea of, the number of rate hikes, quantitative easing, all of that, okay, great. Then we can adjust our protection and also look to sort of allocate our assets more efficiently going forward. So, in other words, no one's going to really close their puts, right? Reduce their hedges till the FOMC. And that's going to keep things volatile. That keeps, I think, tail risk a little bit higher here, right? Because if the market really starts to drop, we'll start selling, the market will start selling off. And we're going to kind of keep getting these really large, violent directional swings, every day up until again that FOMC. The other thing to kind of note, which some of you all may find interesting, is that there are intraday expirations. So, inside of every week now, there are expirations for the Qs, Spiders, and SPX on Mondays, Wednesdays, and Fridays. And so what we'll see in the hero indicator is a lot of times it will register that options order flow is much larger on those days. And we think that's because there's a lot of what we just call day traders, right? They can be sophisticated hedge funds and like, but we're just going to bucket them as day traders that are trying to buy and sell options, particularly this high volatility. They're trying to sell options order that expires, the same day. So, for example, today's Monday. There's going to be a lot of people trading that front contract, right? The front options contract, and that can serve to exacerbate volatility. So, volatility, we think high overall, but on Mondays, Wednesdays, and Fridays, you just get intraday larger swings in environments. Also, because there's so many people trying to day trade these contracts that expire in just a matter of a few hours. So that there's like that added position, right? That can expand volatility or make things swing a little more violently.
Wow. I mean, I recall like from a presentation, like one of your first, I believe. It was back when COVID was just coming out, and the news was bad, and but yet the market buoyed, and stayed, and continued to kind of like slightly go up until options expiration.
Yeah, and it's pretty fascinating. I mean, if you do look back at that COVID sell-off, it really kicked off. It was the third Friday roughly of February, and there was a lot of call options actually that expired that day. The selling actually started kind of towards the tail end of options expiration week, and so that expiration of those calls seemed to kick off, or some of the release the high, so to speak, and the market did cream quite a bit lower. And I think over the next week, we could pull down another 4 or 5% from here. I think with ease, again, because the options market sort of supports that. It throttles the selling a little bit here because of the hedging flows, and because traders are pretty well hedged, as I mentioned before. So we don't get the situation wherein we'll have like a limit down day, right? But we could have a succession of 2-3% down days in a row, just kind of end up grinding lower. And if you look at the way that options are positioned overall, there's a ton of open interest, actually on the call and put side at 4,000. And so, if we were to really get our worst case scenario, it would be 4,000, or the 40-50 level is technically the exact level that we're watching. Wherein, look, if the market does just sell down there, we think that it's an interesting place to look at getting some long exposure simply off of a technical, I guess I would call it an oversold level, for lack of a better term, and people sort of understand that. So there's the ability for the market to have a pretty good slide or sell off here over the next several days is still pretty high. But again, it's feeding into that key time frame of March 18th, which is the big expiration.
Right. So there's a few questions I see coming through about how do you read and use the hero indicator, and maybe combined here also with your notes, cloud notes column.
Yeah, so to keep it really very simple, there's three things that I will watch. One, obviously watching the price action around the levels that you see published there in the cloud notes. The second thing that I watch is implied volatility. So for most of you, the easiest thing to watch is the VIX. And then the third thing is the hero indicator. And that's not necessarily in order of importance. But if I was to look at the way that the market is trading right now, I see the VIX is flat, right? It's about 33.68, call it. So it's not really doing much. Bruce brought up the Vix Futures there. So, they're well off of overnight highs, and they're just kind of trending, right? The market's trying to digest whatever the order flow is coming over the morning. Obviously, there's crude oil made, some big moves. So there's some volatility in other asset classes, and I think the market's trying to digest. So volatility is, in terms of just watching the VIX, is doing nothing at this moment. And the hero indicator itself for equities is, right, which is telling me that it actually seems to actually be shifting bullish there, right? So the fact that implied volatility is not going and the hero indicator is not dropping, that's telling me that traders are not trying to buy put options right now. Obviously, there are tons of other flows outside of options that can affect the market, so I'm unaware of what those could be. But if I'm just looking at the options market right now, I think the options market flow is bullish because that green line at the bottom is going up, and I'm watching for the VIX to confirm, right? Now, the VIX is not going higher at the moment, so those two things make sense to me for the market to sort of feed back up into that big 3,300 gamma level. Now, if VIX was spiking, or shifting up, and that hero indicator was moving down, that would be telling me that traders are positioning for a negative delta or adding negative delta trades, which infers that dealers would have to start selling stock. At the moment, I'm not seeing that. I see VIX coming down, and I see the hero indicator sort of trending up. So consequently, I would not look at shorting this market. Doesn't mean it can't go down, obviously, because who knows what else could be happening out there. But the balance of flow from the options perspective right now is pretty neutral to slightly bullish, I would say. So I try to combine all those things in and around those key trading levels. If the market was to sell off here pretty sharply, I would look for those same signals to turn right at, again, say 32.40, which is the next combo level on the way down. When I say turn, it means, again, hero going up is a bullish sign, VIX going down is a bullish sign. So you look for those indicators to all sort of, combine and sync basically around the levels that we've laid out.
Yeah, interesting stuff. I mean, I reading the hero indicator, like you've mentioned it in the past. It's always kind of interesting how you're reading these flat areas and how the flat areas are actually telling you quite a bit.
Yeah, right. So you have to think of it in a so what is actually happening when the hero indicator is moving up like it was from 9:30 to 10 is those are active trades taking place, right? So that is people. What we're doing is every single options trade that takes place, we measure what the estimated hedge impact is from that trade. So the fact that the indicator is going up is telling you that traders are actively buying calls or selling puts. And then you can see that basically I would think it's around 10:15 to right about now, right? The indicator itself is flat. And so that is telling you that it's just neutral flow that is taking place. So you almost have to, in a way, segregate what happened before 10, right? Because over the last 20 or 30 minutes, no order flow in the options, or it's just neutral flow, meaning calls and puts are, balancing out there, right? So that's a very neutral reading over the last, say, 30 minutes. So mentally, you almost kind of want to like forget what's now happened earlier on the open, right? Because that's a little bit in the past. And over the last 20 or 30 minutes, it's been very neutral order flow. Again, even though the market seems to be selling off a little bit here. So you're exactly right that once that line flattens out, that's telling you that the options market's not really doing anything. It's quiet, right? And you'll see that over the context, for those of you who've been watching, there can be some very violent big moves, particularly around Fed headlines or other events like that into the close a lot of times, particularly today, again, because there's an expiration. You're going to see the hero readings will move very rapidly as traders exit and enter those short dated expiration contracts. So you'll see again that indicator shift a lot, and the fact that it is flat is telling us that there's not much taking place. So the market is selling off, but the options market is sort of ambivalent to that, I guess.
Yeah, really, really interesting. And then I just kind of overlaid the stops and icebergs on here just to try to get maybe a little bit more kind of additional information on what larger players might be doing in here, maybe absorbing on the other side.
Yeah, and in theory here, what we should see is when there are big hero readings or there's a big change, a succession, right, of readings like right before 10, what's interesting to me is that in theory, if that hero indicator is dropping, that's telling us the dealers have to short futures, right, to maintain hedges. And the icebergs will often coincide with that, right? And that to me is sort of telling us, okay, there's been enough of a hero move here to draw out actual options order hedging flow from the market. So, again, if you look right at 10 and you just see the icebergs dropping, maybe you would think, oh, hey, there's some news out that I missed, or something is going on in the market. I don't know what's going on. And if you can see that the hero indicator is dropping, you say, okay, look, this iceberg order flow, these big trades might just be related to options hedging. So contextually, I understand what's going on, right? It's not that a bomb went off somewhere and people are reacting to that. I mean, obviously people could buy or sell puts if that's the case. But if you can't find news and you see the options flows moving, then that can explain a lot of that iceberg order flow.
Yeah, interesting dynamics for sure between these elements. Let's see. Did you want to maybe talk about some of the individual stocks or crude oil? Some of the metals.
I mean, we don't. So at the moment, we don't cover the commodities futures market. But what we have seen, if you take a look just at XOM, for example, we've seen obviously several days in a row of bullish order flow heading into a lot of these names, Exxon, Chevron, etc. And the options market is fairly large in these entities. And so what you will often see here is now there's bullish order flow. And when you see bullish order flow for several days, statistically, we found that that is a positive indicator for the stock going forward. So, it's just sort of relentless call buying in these stocks. As you can see, you keep getting these surges in the cumulative indicator higher, and that's telling us that the bullish flow continues to come, which is quite a bit. Now, what is interesting is you can oftentimes see at key Spotgamma levels, which we have a tool called the Equity Hub, where you can analyze what the big options levels are in Exxon, that you'll see the hero indicator flow change at some of those big options levels. And that telling us that traders are adjusting their positions as we get into the strikes that have a lot of large gamma. So for those of you that are looking to play, say, gamma squeeze or something of the like, when you see the line trending higher like it did from roughly 9:50 to 10 o'clock, you can tell that that's a lot of call flow or positive options flow flooding into a stock. And then once the indicator flattens out, that tells us that that call flow has subsided. So even though the stock right now is at a high, you can see that the hero indicator itself is roughly below, a little bit below zero, and has been trending out. So the options market is not continuing to buy that next level of high, if that makes sense. You could see this, really clearly when the options market really goes nuts, like it was in Tesla, a few months ago. The options flow will flood into a lot of these energy names, and you'll see sort of the flow turn on, and you'll see the line change or adjust, and then the flow will turn off, which means that the indicator, the hero indicator itself, flattens out. So this is giving you a great view into how the options market, both from a technical perspective, meaning dealers may hedge, but also from a fundamental perspective or a sentiment perspective. Are people buying calls, or is something else driving or moving these stocks?
So in essence, though, if you're looking at this hedge impact here, then in the order flow, what you're looking for is like, okay, well, if they're buying calls, like how is the market reacting to this? And they've stopped, and hero is flat. But you still see a lot of buying coming in here in terms of just buying of the actual underlying. Well, that's they're positioned already, so just look for this to continue on up until the order flow says something different.
Yeah, so we save all the data from the hero indicator, and we've been running statistics on it. And what we find is the best, most consistent signal is what we call mean reversion. So what do we mean by that? It means that when large order flow, and this is the trick, is figuring out what is large options order flow, but when large order flow goes into a stock or even the index, and that order flow shuts off, now be that bullish order flow or bearish order flow, when that flow shuts off, the stock will mean revert. So in this case, if it's large bullish order flow, and that doesn't look like massively bullish. I mean, it's bullish order flow on the screen here, but I wouldn't call it several standard deviations larger than what we've seen recently. But technically speaking, once that bullish order flow now stops, we would see the stock mean revert, right? So if you were looking to want to fade a move, buy a dip or sell a rip, so to speak, watching for that hero signal to turn, flatten out and turn is a great indicator that the stock may change its trend on the short term.
So that's great. I mean, I hadn't heard you talk about that one before.
And if you just think about it, right? If you believe that, and we posted a YouTube video about the hero indicator on YouTube Spotgamma. We talk specifically about how options orders are sent into the market and how they're hedged. And so if you think about Wall Street bets, for example, if they all decided that they wanted to buy ExxonMobil today, they would all start putting orders into their interactive brokers or E-Trade or Robinhood app, or right? And when they start pounding a stock, buying calls, dealers suddenly have to react to that. And the way that they're going to react to that, dealers are selling all these calls, right, to Wall Street bets. They're going to have to start hedging. And the way that they're going to hedge is buying stock. So once those calls stop coming into the market, they can stop buying the stock, right? And that's why the stock can fade, right? It's just a matter of watching the order flow come in. Once that buying is done, right, because the options order flow is turned off, then the buying pressure subsides, right? The momentum gets lost.
Yeah. I mean, I'm just curious though, like in terms of a mean reversion, do you typically see it come back to some of these price levels where you see the hero, the hedge impact here in real time?
Yeah. I've not studied, where the mean reversion comes back. I think that, the options market is constantly moving, right? And you can see now in ExxonMobil, what's happening is it looks like bearish order flow has come in over the last few minutes because you can see the hero line is now trending lower. So that's a very interesting concept. It's one I actually should check out, right? Is what does the mean reversion go back to? Is it strikes with large open interest? Is it sort of the idea of, oh, there's a block print here recently, and that's where it should fade back to them? And those are pretty interesting concepts, and I'll have to ask some of the traders actually that are using this a lot to see if they've kind of picked up on anything like that. But I mean, you can clearly see there was a lot of liquidity up there at 87. Regardless of why that liquidity was there, it seemed like once the stock hit that level, it seemed to unleash some negative delta trading. So people sold calls, likely is what I'm thinking, or they bought puts. And
Yeah.
and it really happened right at that big liquidity level there.
Yeah, exactly. I mean, it's a really kind of fascinating way to look at the order flow, a different kind of angle at it with the options information here. It makes sense. I mean, the mean reversion, like you were talking about earlier, but like, where is the reversion to? Like,
Right.
what mean? I mean, does it come back to some of these levels in here, or are we going to look at like a VWAP or something like that in here? Yeah, that's
Yeah, but I think a lot of that is based on time frame, obviously. What is the continued order flow? If this order flow continues to be bearish, well, that's more bearish pressure on the stock now, right? As opposed to if the indicator just starts turning sideways, which is basically telling you, look, the order flow in the options market has really turned off, and so this could be more of a short term play. What's also been fascinating is to see the order flow come in on some of these names that have been just smoked, like after earnings, for example. Like if you were looking to play, I remember Netflix was one where the stock was down, I believe it was like 20% after earnings, and you could see that at a certain point the options flow just turned massively bullish, and that was actually a longer term signal that there was a more material bounce in the stock, right? Because you could see, okay, look, if I own puts and I just made 20%, I'm happy to take those off now, and that signal actually showed to be a multi-day sort of level, rally in the stock. Now, two more recent ones, PayPal and Facebook, that same bullish order flow never came into the stock. In fact, the predominant order flow on those names has been to sell calls, which can keep pressure on the stock lower. So the time frames, have to be, I think, read in context with whatever may be going on in the stock. In this case, there's some day trading flow and some good momentum off the fact that crude is up 10%, right? So those mean reversions, I think, are taking place in the context of a stock that is pretty bullish and likely trending high.
yeah, interesting stuff. Are there other commodities that you're looking at, like some
The
of the
other the other
metals?
place that we've been seeing a lot of bullish order flow is in silver and gold. So if you look at a lot of the gold miners, silver, you have up on your screen there, and gold. Silver, the ETFs themselves, wow, something's going on. The ETFs themselves are a little bit tricky because obviously there's the future, right? So we're watching the options order flow on ETFs themselves, and I think there's a lot of arbitrage between the ETFs and the futures. So it's a little more cloudy, I think, particularly on some of the smaller order flow days in like gold and silver. But when you can see a lot of big time orders will come in, and when you could tell it's a big order because the hero indicator will have a perpendicular line and it will be a big line. So right after 10 o'clock, there's two big orders there. Those are block trades that make that hero indicator jump like that. And the other thing that you'll see is multi-day order flow coming in bullish, particularly in silver the last several days. The GDX and some of the miners are interesting again because you're getting persistent. Every day we'll see big order flow, bullish order flow come in on these mining stocks, and you'll see just continuous sort of uptrend. So you'll get 4, 5, 6, 7, 10 days of bullish order that statistically speaking has proven to be a great indicator for tomorrow and how the stock will react.
So
So you can think of it as like almost like insider buying, stock buybacks, right? You're getting the tailwind from the fact that calls keep getting bought in a stock.
I mean, do you find this effect with most of the ETFs?
Yeah, and it's interesting to watch the order flow in the ETFs because again, a lot of them are tied to futures, or if gold futures start selling off, well, gold GLD is going to go with it, right? There's an arbitrage there. So again, you have to read the options order flow a little bit differently. It's fascinating to watch the same thing in the VIX. You'll get the VIX futures are moving, and the VIX is obviously tied to the price of SPX options. But it's interesting to watch the VIX order flow or the order flow in VXX or UVXY. I mean, as many of you know, a lot of people like to play that roll down, right? The natural decay that's built into the VXX and UVXY. And you can really see when people start to short cover or get squeezed out of those positions in the VXX or UVXY because of VIX spikes, right? And I think in gold and some of these other things, it's a similar thing where maybe I'm long gold futures, but I want to buy puts as a way to. So you kind of have to be able to piece together the way that some of these asset classes are trading against each other. In order, gold futures, GLD, etc. Like maybe I'm long futures, but I just buy GLD put, or there's some other type of arbitrage taking place.
Yeah, I mean it's I mean in Bookmap when we look at some of these ETFs, like the order flow is very, very different. The behavior is, I mean, there's just huge hedging and arbitrage. And you can see it within this instrument as well here. I mean, it's giving nice kind of signal or readings down here, 184 and this kind of 183.75. But if you zoom in here, I mean, just look at how close they are here to the the price and
yeah, you can see there's a great example of a block trade. You see the two arrows there. Someone put on some type of a spread, and then you see that gap down in the hero, which is just telling you that look, some type of block trade went up, and that's how that shows up on the hero.
Do you think there's any correlation between that and this spike here?
I don't. I mean, the reality is those are 2 minutes apart from each other, right? So
Yeah.
it's possible you have to kind of look at what the order is, put that together. I mean, in the same lecture I talked about before, again on our YouTube page, we talked about the big orders and the fact that when a big order like that comes across a desk, a big order usually goes to an upstairs desk, right, like a bank desk or something, and they'll hedge oftentimes before the actual trade goes up. So I would more likely suspect that the big green bar, volume bar there, just a few minutes after, like a minute after, maybe more tied to that order, but that's just kind of speculation.
I mean, it doesn't seem right they can do that. Like they hedge before the position. Don't they have to take the order first?
Well, you have to print it as like the stock, right? So I can make an agreement with you that I'm going to trade. Okay, Bruce, we're going to trade 1,000 contracts of Microsoft, and I can say, hey, trader, put the hedge on while I sort of negotiate the details here or whatever. So. I mean, I think in a way it's not necessarily. You can look at it two ways, right? If once that options trade goes up, you print it on the exchange, you're giving away a lot of information to people, right?
Right.
And so, I think that in general, you have to print it as that a stock order was tied to an options order, and it has to be pretty close to when the trade goes up, as opposed to. You also, from a risk perspective, don't want to print the stock now and then wait. Half an hour or something like that to do your options trade because that would throw your risk off. So
Right.
I don't think that's really a nefarious way of operating, but
Okay. Yeah. No, I was just curious about that. But
I mean, I think there's ways that certainly it's more advantageous to put the hedge up immediately before you put the options order up. I mean that makes sense. Than doing it the other way, right? But that's the interesting thing about it. If you think about an electronic market maker who's just getting pounded with options order flow electronically, they're reacting after the fact, right? After the trade takes place, because they only know the trade takes place when it happens, and then they have to react. As opposed to if I call you up on the phone and we talk about it, then I know before you put your trade up that it's going to happen. Does that make sense?
Yeah, for sure.
So you'll see the stock or ETF or whatever act a little bit differently before those big prints. When more often than, as opposed to when you see a bunch of really small hero flow that adds up into like a curve. That's telling you there's more electronic order flow, and the hedging impact might come after the result of that, the aggregation of a lot of small orders.
So that's when you're looking at the CVD output here in Hero.
Right. So that, there in that screen, there's not a whole lot going on, right? We are having some chunky block trades that have moved the indicator lower, but overall, it's relatively flat. Like you're getting these stair steps, and the stair steps, each stair is like a big order, right? Like a block trade of some kind, as opposed to, if you look at Tesla, you'll see a very clean curve. And we see these curves, it's telling you that this is a lot of electronic order flow coming into the market. See how chunky or how curvilinear the order flow is in here. Yes, there are some gaps, right? But really, what this is there's tons of small orders coming into the market because the line just looks totally different. Right? I'm not sure that what's to try to relay the idea of that, but
yeah. Let me just kind of adjust this a bit here and see what 1,000 looks like, or that might be a little way too much.
Yeah, it's interesting price action so far this morning. I mean, you're seeing. I'm looking at my dashboard here, but there's some bearish order flow in the Qs, put buying, and spiders are neutral to slightly kind of. I guess I just call them pretty neutral at this point. But so far, it seems fairly kind of quiet, even though the futures appear to be. I guess they just more or less mean reverted that move from 7 a.m.
Yeah. So I mean the S&P here, the E-mini is just, it's just gone down a bit here.
Yeah, but if you look at that order flow there, I mean, the options market is not buying puts. It doesn't appear to be poised for a real large sell-off today. So that's the I mean, implied volatility is still holding up, but the idea here really is that when nothing happens in the market, right? If you don't get selling, implied volatility, meaning the VIX will naturally start to come down, right? Because the VIX needs, when the VIX is at 34, that's implying that options traders are expecting a 2% daily move, right? So if the market just sort of stalls and nothing happens, then the value of put options starts to come down pretty rapidly, which puts a tailwind back into the market. So, it's hard unless you're getting new bearish order flow, or real selling to keep that momentum, right? And once that selling sort of stops, the market's going to mean revert on the fact that doesn't look like there's bearish options flow, and the market is also pricing a 2% move, right? So anything under that is going to add a tailwind to the market, as options, which appear too expensive, get sort of repriced, if that makes sense.
Yeah. So when you're looking at the VIX, I mean, how are you how are you reading the hedge impact in here? Or you're looking at kind of not direct correlation, but which one's moving first, or what kind of insight do you get using the VIX with some of maybe let's just say the stock indexes?
Right. So when you look at the Vix Futures, what you're actually seeing from our hero perspective is the hedging impact of VIX index options that are trading. So in this case, if you're seeing positive delta order flow in the VIX, that's telling you that people are either selling puts or buying calls. So, you could see that rate, looks like right after 10 o'clock, there's a big line there. So it looks like, you can see the triangles on your screen as well. It's telling us those are big trades in the VIX going up. And those all look like bullish trades. So from the delta perspective, when you look at the VIX, people are positioning for some bullish VIX trades, which is obviously saying that they're expecting volatility to spike, or they're anticipating that volatility will spike. Now, of course, the VIX in the last moment since we've talked is now pushing back over 34. That's a kind of a bearish indicator there. But that's what this is really watching, right? Are there major bullish inflows into the VIX options space, which is telling you that traders are anticipating volatility spikes? Now, this will be interesting from some mean reversion perspectives if the VIX was to intraday spike very high, right, or get a major move and you start to see the order flow change. That can be an interesting, sentiment indicator, or telling you something that maybe traders are monetizing, some of their VIX calls if vol really spikes. But that's really what you're seeing when you're looking the VIX futures here, and you see
I mean,
hero here.
it's just really curious. I mean, this looks, it's definitely, at least from the cash open here, it's been the VIX is bullish here. But and we look over here though, like at the S&P, it's just slightly going off, or slightly down here.
Yeah, yeah, and it's the VIX index is in particular pretty tricky, right? Because everything is linked. I mean, the VIX is based off of the price of S&P options, right? And then you have the VIX futures complex as well as some of these ETFs, and then you have spiders and ES. So everything is linked, and so it's about trying to figure out which type of order flow is dominant. I mean, I don't think that there's, I shouldn't say ever, but I don't think oftentimes, I mean, Volmageddon comes to mind once, is where the VIX options order flow is really going to start to wag the rest of the market, right? So in the case of watching VIX and Hero, it's more interesting from a kind of a sentiment perspective. But the options order flow in the S&P 500 is large enough, we believe, to control the market. I mean, we talk about that every day, and if you watch our levels, you'll see them come into play, quite often. So again, it is curious to me here, the fact that fairly neutral order flow, but the VIX isn't selling off, right? We're not getting the volatility release yet. So it's a little bit of a drift lower here, but it's a good 10-15 points since we've been talking.
Yeah, interesting stuff. I mean, and then I know you have the SPY also in your cloud notes product here.
Yeah, NASDAQ, Russell are there. We've been talking about ways to expand it into the equities and offer our cloud notes. Unfortunately, from a technical perspective, it's been a bit difficult to offer that number of individual stocks. So we may just choose to do a handful of the most popular stocks, the Apples, Teslas of the world, and offer some cloud notes there. But Hero does work for around 100 symbols. The list is on bookmap.com. And then we offer trading levels on over 3,000 different stocks. So you can subscribe to all of that through Bookmap Marketplace. Sorry, a little tongue twister there.
Yeah, I can. I'll show that here to people, and then also I want to get to your website and show that. Because you have a lot of educational materials in there, and a lot of people have questions about this stuff. So we'll migrate over there in just a second here.
Yeah.
If you're interested in this Hero indicator and the levels that Brent's talking about, go to bookmap.com and click on the More button here, and then you go to the Marketplace. You can click on the text here to the Marketplace, or any of these in here. We'll go to let's go to add-ons, and it should take us there. Okay, it's not. There it goes. Okay, and let's just go to the home page here. It's right here in the top left, and you can look at some of the details in here of what you're getting and the different combinations here. I don't know if you want to talk a little bit about that, Brent.
Yeah, so Spotgamma Pro is you will get the cloud notes. You'll get two daily notes from us, so one around 7 a.m. and then Eastern time, and then another one that comes out the close. And we have an extensive site that analyzes the options positioning in over, like I said, 3,000 different names, and then some more extensive readings in NASDAQ, SPX, etc. And if you go Spotgamma Pro plus Hero, that bundle, Hero is obviously the options, real-time options indicator. So some of you may elect just to get the Hero itself, which is great. If you want Spotgamma Pro, which is just our daily notes, select that, and obviously you can also bundle. And again, that includes our daily notes and anything that we offer at spotgamma.com.
Okay, so yeah, that's where you can find it here to add it within Bookmap, and then we'll jump over to the Spotgamma website here. Anything you want to go through here and kind of point out or go through in here?
Yeah, so we have a few different ways to read the market. We have some welcome notes and things like that walk people through the different ways that we analyze the S&P 500 and individual stocks. So if many of you have heard these buzzwords like Gamma and Vanna and things like that. So we have different charts and metrics to look at all of that. We do have a Discord channel as well, so you can toggle back between ours and Bookmaps. And essentially what you're going to see here is everything we do is about trying to highlight when the options market is in play. So we don't think that every move is controlled by the options market, but we're about identifying when options could be exerting some force in markets, and we are helping to identify and alert you to those positions or situations, I should say.
So I'm just kind of curious. So when those kinds of, I mean, with your background and experience, when you start to see that, or you start to see some of these options metrics and maybe some of the spikes, from what I've seen, you have already kind of factored in that scenario, and you're kind of looking for it already,
Yeah.
or are you starting to look at the actual order flow after the event, or both, to give you the direction?
Yeah, it's really both. I mean, the levels that we put out at 3 a.m. Are about predicting where order flow will change, right? So when we have the cloud notes with our key levels, we think that at those key levels, the order flow should change, and that's what makes it a support and resistance. And then with Hero, it's about unveiling sort of what's happening in real time intraday. And so there we can sort of say, okay, here's what the options market's actually doing, and then we want to react to that. So that's why we're kind of mentioning that. Well, I like to see how the order flow reacts when we hit key levels. So the market's sort of selling off here. If we do get in the 4240 area, I would want to see the options order flow turn bullish, and then the VIX start to sell off, and that would tell me that that is going to be an effective bottom. But from my lens, I don't really have much to do unless I'm short here. Then maybe I want to cover at 4240. But so far, again, the options flow is really not very negative at all. There's a drift higher in the VIX, which is arguably saying that traders are holding on to their put protection or holding on to their downside protection. And on a day like this, when you have convex move in energy and a lot of other things, there could be other drivers. So I would think that the options market would exert more force when we get to our levels that have been set out at which are 4240, as you can see on the screen. The upside, it's 42.
Yeah, interesting.
Right.
So I mean, and these are the SPX, just so people don't get confused that we're at 42.95 here, or
Exactly.
yeah.
So right. So all the options we analyze are SPX index options, and then obviously spiders. So if you see a combo is a combination of the spiders and the SPX. If it just says L3, that's a SPX driven level, and we're looking at the size of all the levels combined, really. So you don't want to ignore spiders. You don't want to only look at SPX. And then the actual label position is at the equivalent futures price. So you'll notice that 4,300 is the SPX price, but it's listed at roughly 42.90, which is the equivalent futures price. Get lost you there, Bruce.
I'm sorry. So
Oh, there we go.
sorry about that. Um, Maybe could you go through just a kind of maybe as a reminder or just an explanation here of what you mean by some of these levels in here, maybe starting
Yep.
up at the level 4 up here combo.
Sure. So anytime you see combo, that is a level derived from looking at all of the options gamma in spiders and SPX combined. So we combine all that gamma. We look at basically a total S&P 500 view, and then find the 5 largest levels and print those on the charts. Now the level has to be of a certain size for us to print those out. So in this case, you're seeing 5 combo levels, right? But if we don't see that there's enough hedging flow or enough gamma at a certain strike, then it won't show up on the chart. The next you'll see, so L1 is the biggest, L5 is the smallest. The next ones you'll see are L3, so L1, 2, 3, 4, and 5. That's looking at only the SPX flow itself, not spider flow, so that's why it just says L3. And then the other 2 levels that you see on the chart there is our vol trigger. So our vol trigger is our proprietary level at which we see gamma flipping from positive to negative. So many of you are familiar with the term of gamma flip, or they'll call it zero gamma point. We have a zero gamma point as well, but we just provide that so that people know basically what everyone else is looking at. proprietary level, the vol trigger tells us where we think options support and resistance based on that gamma flip is set to take place. So you can see in this case, it was around 43.25 of the SPX. That fortunately proved to be major resistance this morning. Market rejected off of that level. So below that, we see negative gamma positioned in the S&P 500, and above that vol trigger levels, where we see positive gamma and lower volatility taking place.
Okay.
And then the final. Oh, I'm sorry. Go ahead.
Anything that that has combo means it has SPY as well. But if it does
That's
not,
right.
if it does not, like a vol trig, put wall, or just L3, for example, that is just SPX.
Right. So combo L1 is going to be where we see most of the gamma positioned, and that should be our strongest support and resistance level, if you want to think of it like that. L2 is our next strongest level. L5 is kind of our lowest level. Now there are hundreds of strikes, obviously, that also have gamma tied to them, but they're too small for our models to care. So we only try to show on screen what the biggest levels are, quote unquote. And then the last level you see down there is the put wall. The put wall tells you where the largest put gamma is. So the strike that has the largest put gamma. Interestingly, our studies show that the movement of that we see that as a support level, but actually the put wall shifting higher is correlated with rallies in the market. 60% of the time when the put shifts to a higher strike, the market rallies the following day. So there's some interesting correlations and studies we're able to produce. You can read that article on our blog at Spotgamma.
Okay, so let me find that here. So we'll just go up here to
you go to free resources and then blog.
Okay.
And then if you just search for option wall on that top site, it's going to be buried in there a little bit, but
okay.
Search site at the very top.
Oh, okay.
Yep. Just type option wall. Hopefully it comes up. There it is, stats. There you go.
Okay.
So in here we have two level. We call one of our levels the call wall, which is where most call game is concentrated. The second one's called put wall. So if you just kind of read through this article, it actually lays out the number of times those levels have been touched over the last couple of years and what happens to the market intraday and in the following day, based on
Interesting.
when the market interacts with those levels.
Yeah, yeah. Also, under free resources here, maybe I know you guys did some really good videos. Is that under the free training here?
Yeah, so we have a course called 30 for 30, which is a very basic, quick walkthrough of everything from what is a stock, what is it, up to some of these core concepts like gamma and vanna and those types of things. So you hear those buzzwords and you just kind of want to understanding what that is. That's what these 3 courses offer you. So there's a free thing called 30 years of education in 30 minutes. We also have something called the Spotgamma Academy, which is a instructor-led course. It's much more intense. That's what that next link down there is. So you can sign up for that, and we will walk you through in depth. What are calls and puts, obviously, but what are all the Greeks? How can you trade them? What are the second order Greeks, gamma, vanna, etc.? What is implied volatility? How do you use it for your trading? And I think one of the key things to note here is that even if you're just a futures trader and you don't trade options, if you understand these concepts, there's the options complex in the S&P 500 is so big, and we've all seen over the past year how options can move stocks, right? The GameStops and AMCs of the world, but Teslas and all that. Just understand that order. I think it really helps to unveil a lot of the price action that you see, and it can help you make a more effective futures or stock trader.
Yeah, excellent. Okay, so anyway, yep. If people are interested in this, you've got the marketplace here. You can check it out, and then you have a lot of resources here from the Spotgamma Academy and the blog and the website and courses, etc. So. Yeah. Anything else you want to go over?
No, I would say that the pro service is a free 7-day trial. So, try it out. If you like it, awesome. If you don't, no harm, and
this one here.
move along. Right, right.
Okay.
So, you get, we want everyone to, it takes a little while to get used to our nomenclature, the way we call different, levels out and things like that, and get a feeling for what the data is telling you. So that 7 days should give you hopefully enough time to really get a good assessment and figure out if the spot game data is going to help you. And
Yeah. Okay. Yeah. Thanks, Brent.
absolutely, thank you.
Yeah. I think we've covered just about everything. Let me just take a quick look for some questions here. It's a little more difficult here in YouTube to try to cover that, but maybe we can cover something here. Hold on.
Sure.
Yeah, I mean, it's just kind of requests for looking at certain things, and then also about pricing, etc. In here. So yeah. So we've been going just about over an hour. Um, really appreciate it, Brent. It's always just fascinating stuff, and a very unique perspective, integrating not only real-time hedge impacts here, but all these different metrics and things that you come up with and correlations, and understanding the market in a much bigger picture. Yeah, thank you for all your insights here.
Yeah, well, thank you for the time to speak with you, and I appreciate everyone their time as well. I know the market's pretty busy here, so it means a lot that everyone's taking a moment to listen to what we have to say.
All right, thanks everybody, and yeah, we'll good trading, Brent, and we'll catch up next time.
Appreciate it, Bruce. Thanks.
Okay, bye bye.